Cool. Welcome, everyone. Thank you for joining. I'm Gil with the Stanford Blockchain Accelerator. We're part of the Stanford Blockchain Club, and I'm joined with Paul Vraticket. Did I pronounce that correctly?
Vraticket. It was close.
Vraticket, sorry. From Pantera, and he's going to be speaking to us a little bit about the blockchain venture life cycle. Quick plug on us, who we are. The Stanford Blockchain Accelerator is a student group where we help incubate 20 teams a year, usually 2 cohorts of 5 from within the Stanford community, so Stanford students and alumni, building blockchain ventures that are driving adoption of blockchain. And it's everything from infrastructure, dev tooling, user experience analytics to compelling real-world value use cases. But the aim is to really promote and further decentralized and blockchain technologies. 2 seconds on me, and then we'll get to the more interesting person in this room. I'm Gil. I'm an ex-engineer and entrepreneur. I built a couple of companies in the distributed compute space, was at GSB in 2016, and I'm currently in the School of Public Policy. And I run the Stanford Blockchain Accelerator. I also help co-teach a course in the engineering school on blockchain entrepreneurship. And I've been in the blockchain space since 2016. So I've seen some ups and downs, but I don't think I come close to Paul. And with that, let me turn it over to Paul from Pantera. And Paul, would love to kind of hear a bit of background on yourself. And if you could also just share your story of how you got into blockchain and kind of a little bit about your journey.
Thanks, Gil. Really excited to be here and have a lot of respect for the Accelerator. Met a lot of great people, those that are organizing it, those that are part of it last time around. My name is Paul Vraticket. I'm a managing partner at Pantera Capital. Pantera Capital is probably the earliest institutional investor in blockchain companies and currencies. Started by Dan Moorhead, who used to be at Tiger Management as CFO, head of global macro trading. We've been doing this since 2013, investing into Bitcoin since it was $50. And, hedge funds and venture funds later, we manage about $5 billion. We've done over 200 deals, and it's been quite the journey. So my background, don't hate me, I went to UC Berkeley, but very, very proud of it, wearing a blue sweater here. But I graduated from there, and I started off my career as an economic consultant, got my feet wet in terms of research and modeling and financial services, but quickly realized that, how to get out of there, how to do something a little bit more entrepreneurial. I joined an early stage startup on the business development and partnership side, and then got into the wonderful world and the dark side of venture capital. So I've been doing this now for almost 13 years. My last fund was focused on mobile apps and mobile infrastructure. So I started off as an analyst. In case you guys think of a career in venture capital, I can tell you how it is to go all the way from the bottom to sort of where I am now. And, my last firm, again, was able to look at one space only, which, you better pick the right space or else you're going to be out of a job soon. But mobile tended to be something that I felt like was promising, and it's become just tremendous, new computing sort of paradigm, and it's sort of brought together sort of a next generation of applications and data. And so I was doing that for a few years, but the moat around mobile quickly evaporated. Being first in mobile and using data as an edge, just a lot of VC firms came into mobile pretty quickly. And so I really looked for my next edge, and heard about Bitcoin actually from another investor. Dismissed it at first because I felt like, all the investor was talking about was mining, which to me was interesting, but really just didn't get to the root of, a use case or an application that cryptocurrencies could really sort of solve. And, finally, as I talked to some of the early companies in the space, I realized that there was something here. something here in terms of store of value, something here in terms of payments. Payments could include many forms, but especially cross-border payments. And so I realized that like there's something disruptive here, and I could go and become an entrepreneur in this space, but I felt like I could do a lot more during this time being an investor and putting capital with all of the right entrepreneurs and guys that have a bit more experience than me, and hopefully building companies that can really take this currency, this technology to the next level. So I found a really good fit with Pantera Capital. They were starting to go into venture investments, and I kind of came in there and kind of took hold of venture investing for Pantera. So I've joined the space since March of 2014. And, since then have really sort of formed, the way that we should be thinking about areas to invest into, and then also sort of serving as kind of like a one-man platform until we actually thought about building a larger platform function, but one that's really geared towards helping crypto companies. And we can definitely sort of get more into that. Think of us as really first round capital for crypto, the way that we've sort of thought about platform, but I think it's going to go, even beyond that as, the space grows. And then of course, just building a world-class team to sort of execute on investments. Most of my deals so far have focused a bit more on market infrastructure. So I led the Series A in Alchemy, which is, I think, the leading developer platform in the space, and also have done things around staking and consumer on-ramps, and then sort of now into NFTs and things like that. So, I think really, we're really early in the ecosystem, and, there's a lot to sort of share in terms of what I've gone through across the different cycles, but also how we think about investing.
Awesome. Thank you. And I love that you say that we're early in the ecosystem, given you've been here basically a decade. I agree with that, but it's sometimes people might think that it's late, but no, not at all. I guess as you've seen the different journeys of blockchain companies, right? So regular ventures tend to have their own life cycle of raising pre-seed capital, then seed as they look to identify options for product market fit, maybe build out their product, to prove product market fit, hypothesis, they'll have a few customers, B for growth hypothesis, C for continued growth, D. Blockchain is obviously a different beast and an animal. And candidly, I'm sure you've seen it shift and evolve over the last decade from raising money through ICOs, pre-product to post-product to kind of the NFT boom. Would love to hear, I guess, what do you think is currently a sample life cycle? And I know these are going to be different, obviously, for an infrastructure company or a dev tooling company, but if you could give a few examples of what does a life cycle of a blockchain venture look like from ideation through launch?
Yeah. So right now, we are still very early in the ecosystem. I think a lot of things that are being built out are considered infrastructure, and we haven't really come across a lot of killer applications yet. I think it's also reflected in, our strategy and the types of deals that we are seeing, where when we started off investing in 2013, we had a venture fund and we're investing into equity in companies. And the earliest use cases that we were focused on were really around how do you get people into crypto? How do you sort of get fiat into crypto? And then how do you do that in a secure way, both for retail and then also for, more professional investors? And then of course, what are some of the early applications around this? And this revolved a lot around exchanges and brokerages. And if you look at that segment, it's the only one that's actually reached a growth stage right now, really. Again, there's some exceptions, and I'll talk about those, but really, Coinbase, Binance, formerly FTX, Kraken. I mean, these are all ways to get fiat into crypto. That's the first step to really educating people on cryptocurrencies, is giving them a taste of it and giving them a chance to speculate so that they can think about what they can actually, you know, what the technology means and what they can actually do with cryptocurrencies. Is you have to get some in their hands. And so with that in mind, because those are the only companies that have reached sort of like scale, in addition to maybe, a few leaders in certain infrastructures, such as NFTs, say like OpenSea or Alchemy on the developer side, or, Uniswap on the DeFi side of things. Everything is still fairly early. And so for us, I mean, the strategy that we've taken is really to focus mostly on the early stage, unless we do see a clear breakout of a category that we know is going to be here for the long term. So we do have, obviously if we get into them early enough, then they kind of turn into these great sort of growth companies. But, we'll do some growth stage investments where, it's like 500 million to $1 billion, and we still see 5 to 10x at least upside because they are leading a certain category. But for the most part, we are going to focus on seed and Series A deals and now Series B deals, because we're starting to see some companies that are starting to achieve product market fit and can raise a bit more capital to sort of, sustain bear markets and that sort of thing. And so Series B rounds and the sizing make a lot of sense. And so that's kind of where we're focused on the equity side. And we'll get into a little bit more detail on sort of what companies look like for each of those different stages: seed, Series A, Series B on the equity side of things.
I like what you were getting into a little bit there, and I want to double click a little bit on it when you mentioned kind of what stages people were at. So you might have like a white paper for like a pre-seed. You might have like some traction on your second round, and that might be a seed or an A, and then a pre-launch round. Can you describe a little bit more like what do companies look like when you're giving them their first check? What types of people are generally on the team, and kind of what stage they're at, and then that second check and third check?
Yeah, for sure. So, in terms of team and in terms of like what's sort of there for each of these projects at each of these different stages, I would say, the pre-seed is usually, you'd have a CEO and a CTO, and I'd say like it's usually one or two. I actually think that like with pre-seed, I mean, it's so early that it's not atypical to just have one person. And, if it's that one person, then of course, like you're betting on him, and you're betting on him to be able to, or her to be able to build a team around and be able to make sure that all different things are needed to kind of get to that seed round. But, in terms of a more common, team is usually, at least two people, business person, technical person. I think if it's, a project that's focused on consumer, I do think it's nice to be able to have a designer either as an advisor or as part of the founding team, just because design and user experience is such a big deal. But again, it's not necessarily needed. For an equity company, it's great to be able to just like, have a deck, have an idea of what they're trying to achieve, what their vision is, and how they're trying to get there. For a token project, it's always great to have something similar. It's great to be able to have, if it's fairly technical, to have a sort of a technical white paper, or maybe even a light paper. I think it just kind of gives you a sense of especially if there is a moat around the technology, I think it just is really helpful. If there's not really a moat around the technology, then just having a deck is fine. And, it's even helpful to have some Figma, some screenshots, just to kind of give people a sense of, what you're trying to create and some sort of tangibility there. And that's probably enough for a pre-seed. I think once you start, go for it.
Just a quick question on that. If you are building a technical project that will have a token in it, do you generally expect like the tokenomics to be solved at that point, or are you seeing more like those are pushed off to a later stage and initially it's just a focus on the technology itself with tokenomics being perhaps figured out another time?
Yeah, not usually in the pre-seed side of things. I would say having the idea and having just a sense of like, how value accrual will happen. And so you might just say, hey, these are a few of the different ways. It's going to be similar to Uniswap. We're just going to have mostly a token that functions more like governance and has like a fee switch later on. Or, this is going to be maybe similar to this model or that model. I think that's probably enough to be able to just say like, hey, there is going to be value accrual on the token side of things. This is kind of how we're thinking about it. But again, we still have to really figure out what that model is going to sort of look like.
Awesome. Okay, cool. So finish the white paper, finish the deck, have that first round of funding. What then? What do they generally have to accomplish before the next round?
Yeah, so if that's kind of where they're at, then I'd say in the seed round, you probably see a bigger team. Let's just say could be up to maybe 5-6 people on an average. I'd say it's probably going to be mostly developers, and you're probably going to see a product that's a little bit more built out and maybe some early design partners, if it's like enterprise, or maybe even just like a beta where you have like a white list, or maybe even like a wait list and then sort of a larger group of folks. And you really do have a product that you can play around with and sort of test out and be able to get some early feedback on. That's where I'd say probably the seed round sort of happens, where you really get to play around with it. You really get to do some customer references. And, I think these days, it might actually have some pretty significant traction on the seed round side of things, because we're seeing some seed rounds that are maybe a couple million, but we're also seeing some seed rounds that are like 5 or 6 million. And so that's kind of what we're seeing. I guess some folks can start to kind of go straight to the seed round, but those ones are entrepreneurs that probably have a little bit more credibility and track record, where you feel comfortable with a higher valuation and letting them be stewards of a larger amount of capital. Again, it's not a fit for a lot of funds, but again, for larger funds, it's great because you get more skin in the game usually, and from sort of a dollar perspective. And that also means that like you have a little bit more control over the company. There's a board seat, like that sort of thing. So on the seed round piece, it can be very different depending upon what level of entrepreneur you are.
Awesome. Right. So generally some level of traction and customer validation to show that this is actually useful and people are interested in this and like it, and a bigger team, and kind of you've built some sort of beta. Do you mind if I, like, real quick before we go to the next round, just ask you, and this is
Sure.
obviously shifted and has ranges, what are some valuations that you're seeing in pre-seed? What are some valuation ranges that you're seeing in seed now versus maybe like 9 months ago or a year ago?
Yeah, I feel like things have probably shrunk in, I don't know. So the way that I think about it is like the later the round, the greater the discount right now. So, companies that were raising at 10 billion their secondaries going on at like 3 billion. And I think that discount lowers as you get earlier because there's just more VCs that are focused on the earlier of stages or can go earlier. Everyone can go earlier, but not many can go the other way around. And so I'd say the discounts shrink all the way down to maybe like 30% to seed or something like that. And so in terms of like ranges right now, I'm starting to see pre-seeds going from maybe 6 to 13 million. I'm starting to see seeds go from, this is probably like there's a wide range. I mean, let's just say 13 million all the way up to, I'm starting some C rounds like 5-6 million. So maybe like 40 million post. On the Series A, man, I mean, it can go from, let's just say 40 million to 200 million. And so I'd say one way to sort of think about it right now is when we were in more of a bull market, we would see companies diluting themselves in around between 5 to 10%, which is not that much compared to the norm. But in a bear market or where investors have a little bit more leverage, we're starting to see dilution between 20 and 30%. And so what that means in crypto is really interesting because, crypto has expanded beyond just crypto VCs. You now get a lot of traditional VCs that are looking at this space, and you've gotten some growth stage VCs, but none of them are looking at this space right now. I think they're all kind of focused on the public markets. But there's now an opportunity where if you are doing something that crosses between crypto and non-crypto, you can actually have sort of co-lead scenarios where you can get two fairly prominent firms and still get them in for at least 10% each. Some guys had that threshold where, do I really want to spend time with the company unless I have like 10 to 15%? Well, now that rounds are diluting companies all the way up to 25, 30%, you can actually fit in a Pantera and a Sequoia, Pantera and a Benchmark, and both can kind of still feel incentivized. So that's also kind of interesting.
Awesome. That's super helpful, very aligned with kind of what we've been seeing as well. So, all right, let's get back to the story time. So Series A, so you've got your initial customer validation, you raised a bunch of seed money. Now you've been building, how far do you need to go?
The Series A, this varies the most, where on the one end, you can have someone that sold a company for hundreds of millions of dollars launching a new company, and you just jump straight to Series A. Maybe something like, I don't know if you guys follow Gabe Layden and what he does at Limit Break and what he did at Machine Zone beforehand. Looks like he just skipped straight to a Series A. I mean, first round was probably like 40 on 200 posts or something like that. And then of course, like it's then raising 200 million total across 2 rounds. And that's probably like a fat Series B that he put on there. So those types of founders, Elon, whatever, Jack Dorsey, like they'll go straight to an A or a B. But I think kind of the normal A would be, I think companies that really have sort of just demonstrated product market fit, and you could really just, the product is open to the public. You really can do things like look at different cohorts and really sort of understand what the retention is and what the sort of like average customer value is and lifetime value is, and you can actually just dive into the data a bit more and really understand what's going on to really potentially understanding if they are leading a certain category, what their competitors look like, and a lot of things around the team. It could be up to maybe like 20 or 30 people. So hiring is a bit more de-risked. Technology has been battle tested, and you really feel like these guys have a good shot at winning their category. So that's on the equity side. On the token side of things, it becomes a little bit more gray area where it could still be very, very early, and you would hope that they were able to, test out their product with, I'd say enough sort of, fake token testing, or being able to get like a certain, list of beta customers. But again, like you can't really go public until the token launch. And so really some of these Series A's are to really just get the right strategic partners involved, and those that can only invest into a private round, or like highly likely to invest into a private round, because buying tokens is just, figuring out the custody and the volatility is just not their thing. And so a lot of these Series A's are done by either the larger funds that really want to double, triple down into existing winners, or, feel like there's a lot of potential here and enough has been de-risked for them to put in quite a bit of capital. Or it could be some of these larger exchanges or strategic partners, maybe even like influencers that they want to get in. But, you'd hope that there's been sort of enough testing, at least with, a subset of folks. And a lot of it is still really a team bet, for some of these like pre-launch rounds.
Awesome. This is great. So by A, you've kind of built a product, you've de-risked product, you've de-risked team, and you're looking to bring on strategic investors that can support you kind of in the next phase of your launch and in general in your go-to-market. And at this point, you're probably running on some sort of test net with like testing out your tokenomics and kind of modeling that. All right, so you do that.
At this time, the tokenomics piece should be fairly fleshed out. That's a good point on the tokenomics piece.
Awesome. A question on what comment you made earlier around when you're doing Series A, you kind of have a better idea around quote unquote product market fit, numbers around like engagement and churn, or et cetera, for users of a platform to some degree. How do you think about that in the current climate versus the bull market? And some would say that, for instance, the NFT boom, people definitely had product market fit because there was a ton of engagement. And how do you, I guess, disentangle speculation frenzy and kind of interest in just appreciating tokens versus utility of an actual platform? Or am I thinking about this wrong?
Yeah, no, it's tough. I mean, I think in general, if you invest into infrastructure, then I think it's one of those things where you're really just betting that NFTs will become a thing. And so obviously, if you are investing, at the earliest of stages, then you can take a little bit more of a flyer on the space. But if you are investing into open seas like Series B or Series C, then you really have to think about, hey, like based off of what I see so far, how big could this space get based off of just speculation? And then of course, if it starts moving into other markets like Porsche NFTs or NFTs with like real world assets and things like that, then it just becomes larger and larger. And, does that make sense from a risk reward perspective, knowing where we are in the market to kind of make that bet at this stage? So it's really, trying to just figure out like where these spaces are going. And if you're going into in the infrastructure side of things, then it's really a bet on the space and the team, versus if you're betting on a specific application, then it's really, I'd say it's really just diving into, I think at the end of the day, I mean, seed is different, but like if you're going into something growth into an application, I think it's really trying to figure out as much as possible what they're doing on these specific applications, and if it's, sort of sustainable. Imagining if like they have a token and token prices drill. I mean, it's basically like, do you have a product there that is enticing without a token? I think that's one thing to sort of think about it. If the product is only enticing with the token, then I think and that's why people are just really understanding that, like, hey, let's really figure out product market fit before layering on a token, because the token should not be a reason why a product is being used. I think that's kind of the biggest thing that we are just continuing to sort of figure out, is that like the token should sort of enhance a product. It shouldn't be really the product.
Yeah, no, I like that a lot. Along a similar vein of thought, we've got a bunch of teams that were building last year, folks that started 6 months ago, that now are potentially considering pivots. What are some ideas that perhaps a year ago you would have been gung-ho and investing in that now you're not, just so that as people like reassess the market, I think this will give them good insight into things that, well, maybe that market actually isn't a viable market currently in this bear market.
Yeah, I mean, I think anything that is consumer related is pretty tough right now. So I'd say, especially in areas that haven't been proven out in terms of having, like, you know, some fairly large winners, at least from a revenue or valuation perspective. And, you know, so I'd say like gaming has been tough right now. And I'm not saying that like gaming is not going to work, but I'm just saying that like it's tough right now because the only data point that folks can point to is Axie, right? You know, that kind of got to a certain stage, and the tokenomics piece, plus also, you know, how best to sort of utilize crypto has not been figured out yet. That's one where I think it's tough, but there's still a lot of potential. I think another one in the consumer side of things is around DAOs. I mean, I think DAOs are extremely important, especially around sort of just decentralization, and especially the decentralization of finance. But, you know, in terms of infrastructure for DAOs, and DAOs actually, you know, being successful in you know, making decisions and all of that, I think it's still TBD in terms of what's really sort of effective and what's needed. So I think DAO infrastructure, DAO tooling was an area that folks were looking at, but it just seems like more people have just other sort of priorities right now in terms of just building product than actually figuring out the governance piece. So that's kind of tough. I think on the NFT side of things, I think there's been a bit of a shift where, you know, a lot of folks were focused on launching NFT collections, but then again, like, you know, outside of speculation, there hasn't been a lot of utility for NFTs. And so I think both retail and institutional investors are taking a step back. I'm still bullish on NFTs. I'm still like I'm bullish on gaming. DAOs, I'm hopeful. But on the NFT side of things, there's been a shift towards like trying to make NFTs a bit more useful. And so that means like, and I don't know if this is going to sort of take off sooner rather than later, but there's been a shift on trying to basically provide infrastructure for larger brands to create NFTs with more utility. So again, partnering up with folks that already have a user base and saying, hey, we can help you figure out an NFT strategy where we can incentivize folks to hold, because it's not just like, you know, a profile pic, but it really ties to certain benefits, whether they are, you know, more about like perks or whether they're actually like ties to like real world, you know, assets and things like that. And so that's been a pretty interesting shift too. We'll see how it plays out. Maybe it ends up being sort of like in 2016 where everybody was like moving over to enterprise blockchain. But I think this one has, you know, maybe a little bit more legs. It just may take a little bit more time. So those are some of the areas. Consumer is probably the toughest area right now where folks are really trying to rethink things.
Awesome. There was a question in the chat that I actually really like, which was, what's the typical runway? It specifically asked between seed and Series A, but I'd even ask between like pre-seed and seed. When you're raising, what what amount of runway would you expect yourself to raise, and whether it's a specific time or a specific, like, how much time should it take for you to raise, and then what you should be able to get? So curious what your thoughts are between, pre-seed and seed, seed and A, and then potentially A and beyond.
Yeah, I mean, I think the runway probably decreases the earlier the stage. Again, there's always the factor of like team, right? If you have an all-star team, can sort of change things along, but like, if you're doing a pre-seed, you probably don't need as much runway, considering like the milestone is not like, maybe as sort of large, and the valuation is not as large, versus if you start getting into Series A, then you might want a little bit more runway because, it gets more competitive. Like, you have to start spending on like acquiring users, and you can make mistakes and things like that. And so I'd probably say it ratchets up in terms of length of runway the farther you get, and sort of the expectations and the competition just kind of increases. Again, there's always like little things that can sort of change that. So I'd say like, at least a year, or maybe close to a year for pre-seed. I'd say, I'm just ballparking 18 months for seed, at least 2 years for Series A. And of course, if you're in a bear market, then just kind of add an extra like 25%, just because, again, it's going to be harder to get to market in a market like this, versus if you're in a bull market and you're kind of closer to making money, then of course, like, it can also shorten.
Yeah, I use similar numbers, but I actually tack on a little more because you may want to give yourself like another 3 to 6 months just to raise. So like a year plus 3 to 6 months to raise, 18 months plus 3 to 6 months to raise. But yeah, this is kind of similar. So appreciate this. Awesome. I think that's super helpful. Sorry, I had my list of questions here. So take a step from the like happy path to the sad path. What are common failure points for blockchain ventures, and things that you've seen that have killed a venture, mistakes that people have made, or common mistakes that people have made at different stages?
Yeah, I have a few that I can think of. So I think first is, it's really good because it ties into your last question, in managing burn. And so obviously, managing burn can be very difficult in crypto because the highs are highs, and you can really think that you're having product market fit. And so you can just be spending just a ton of money on acquiring users and doing all of that. And then all of a sudden, the lows are really low. And so you spend so much money, and you're like, okay, I'm about to fundraise, and then all of a sudden, like, the market drops, and you're like, oh wow, well, fundraising's gotten a lot harder, numbers don't look great, and our runway has shrunk quite a bit too. And part of that is also like, some people, their business models depend on tokens, and so during a bull market, your numbers get even more inflated because, let's just say you're a staking company and you're getting, you're validating for Solana, you're getting Solana's going up to the moon. And then all of a sudden, like, business goes down and the price of the token drops by 90%. So everything just gets compounded when you have a token involved too. And so it can be just really, really tough to just manage burn when a lot of things can go at you when the market, comes down. So I think it's really, that's why, like, folks that have gone through markets before can sort of say, hey, like, we should spend money in the right places while still maintaining a certain level of runway, knowing that this could be short-lived. And so I think that's something that, some more experienced entrepreneurs can sort of learn from. But a lot of companies that look really, really good during the bull market just fail because of just not being able to manage burn. So that's one thing. Another thing I think is really just, regulations. I think that's something that it's really, really tough to control and has really just stymied companies. And so what can you do? I mean, there's some things that you could probably control yourself in terms of, moving out of a different geography, pivoting, that sort of thing. But, I think it's one of those things where, like, being very, very cautious around how you scale a company if you know that it's an area that could be heavily regulated, and not being afraid to sort of pivot away if things are not looking good. So I think that's one area. And then and the last area, I think, is just really the same thing that, like, it's almost similar to how you get out of, regulations. It's around timing. Sometimes it's just too early for certain use cases. Sometimes it's too early for voting on the blockchain. Sometimes in 2017, when we were betting on NFT companies, it was just too early. Like, the awareness of crypto wasn't there. The brands weren't there. The influencers weren't there. The infrastructure wasn't there. And so can you figure out if something is going to take off in a short amount of time, and you do enough, like, customer chats and everything, and can you pivot out of it if a certain space isn't going to work, and maybe it works later on and you come back to it. I mean, there's, I'll give you a great example. Circle. I mean, they started off in 2014 and they were competing with Coinbase, and it looked pretty good, but, it was a little bit of an uphill battle since they started a little bit later. They decided to move away from crypto. And, they luckily got back into crypto at the right time with the right idea, stuck with it. USDC seems like it has some legs. And so I think, while some may say, oh, they could have just, continued with USDC for a long time, but, I think all those things that they kind of did to figure out USDC was sort of helpful, and probably gave them the runway to finally get to USDC. So it's those type of founders that can really quickly figure out if something's working. If not, move on to something else and just keep trying and being persistent.
So on that, and I think that's a great example, if you are in a market that you think we are too early in, or the market is simply too early, should you then pivot to something else completely, or should you try to, like, promote the like, vertically integrate, quote unquote, to try and drive demand for this thing? Like, or should you just, like, wait and work on a different idea? Like, curious your thoughts from a risk perspective. And I know this is super, like, specific to a type of idea, but
I think number one, it depends on your runway. It depends on your runway and how much confidence you are that this market will pick up within a certain amount of time. And then you could basically at least build up a brand and build up the relationships and the infrastructure so that when it does pick up, you're ready to go. But again, like, some folks don't have years of runway when they raise capital, when they're figuring things out. So if that's the case, then it's really just surviving. And again, there's multiple spaces that are going to be successful here. So you may just move on to a space that is successful, and, maybe there's an opportunity to go back to that previous space, or maybe it's one of those things where you knock it out of the park with a different space, but you built a lot of things for that other space. You could sell it, and another company will buy it, and you'll basically get exposure to both, because you'll have a little bit of equity or at least extra runway to give you some more cushion to target a new space. So there could be different ways where you can kind of make it work.
On the regulatory side, so I think there's been a trend, both in tech period as well as in crypto blockchain, to ask forgiveness versus, like, to be overly cautious. And generally it's worked out in the sense that by the time you'd get targeted, you're successful enough and have enough money to at least try to fight it, versus trying to do all of these mitigation techniques and spend money on a legal team when you don't have any. Do you think that is still like a good approach, or that now we're just moving into a time where everything is much more heavily regulated post FTX, post potentially like Luna, not that there was fraud there per se, but do you think we're just moving into a more heavily regulated environment, and actually you should spend more time on the regulatory side, or really just, like, build something that people love and figure that out later?
Yeah, this is also one of those questions where it depends. I'd say if you're doing something that is fairly similar to what has gotten scrutiny, then I think you better spend a bit more. Like, for instance, like investing into a stable coin that that may or may not be algorithmic. You probably want to spend a bit more time educating investors and other folks that this will sort of fly versus if it is something else that is maybe like NFT related or something that there hasn't been a lot of guidance in, then you might have a little bit more of a leash. So I think it really depends on the sector and what's been done so far. But in general, I would say in this environment, post FTX, the more validation that you could do on the regulatory side of things, the easier it's going to be, for sure, especially if you're in the US.
Awesome. All right. And last question. Our mission is to drive blockchain adoption. Curious, what are your thoughts on what are the biggest gaps or things that teams could/should work on to have? Is it, where do you see as like these critical challenges, or is it everything? Is it infrastructure that just isn't performant enough or is too expensive? Is it dev tooling that is just really difficult to build anything viable? Is it the user experience, or is it that we just haven't found a real world use case that really could like operate at scale for value to push adoption?
Yeah, I mean, I think it's twofold. I think we definitely have to continue to build and make it a lot easier for both developers, and then of course, what stems from that is, better user experiences for both retail and institutions. So on the retail side of things, yeah, if you have more developer tools that can, give developers an easier time to sort of like make things where, account abstraction and things like that could be just like cross-chain, that it could just be a lot easier for users to kind of get in. And then on the institutional side, we're probably going to see companies that focus on doing things in a regulated way and a secure way, and kind of becoming like an in-between, all that complex, like, technology stuff and the interface to these institutions. So, I think that's all really, really important. And, some new technologies like zero knowledge and other things like that will be sort of interesting. But I think the other piece is really on the education side. When there's something that is picking up traction, it's really being able to educate folks on, why blockchain is sort of necessary, and basically just being able to like flesh out some of these different use cases so that it's really understandable for people. And part of it is going to be hopefully sort of like non-speculative use cases, but like once we do hit some of those, then it's really just education on the market so that we can improve upon the brand, which I think the space has a brand problem right now.
Awesome. We're just hitting time. Paul, this has been amazing. Thank you so much. Really appreciate it. Any last words of advice that you have to give, or?
Yeah, I mean, really, really appreciate the time. I hope you guys learned something here. And, if you guys want to reach out to me, my Twitter is my last name. I have a blog called The Verada Verdict. You can subscribe to that. And then, also feel free to add or hit me up on LinkedIn too. Those are all avenues that I check.
Sweet. Thank you so much. Appreciate everyone for joining, and have a good evening.
All right. Thanks, guys.